Hi, my name's Leon Rowe, currency trader and trading coach at trading180.com, and welcome to the Stop Hunt Forex trading course. And in the course, this is what I'm going to be covering, which is the zero sum game, a bit of a reminder and why it's important, the Forex market share, iceberg orders, liquidity, and slippage. Stop hunt technical analysis setups and the stop hunt pin bar setup. So really, iceberg orders, liquidity, and slippage is the main reason why, or are the main reasons why stop hunts occur. It's not a conspiracy. It's not something that is theory or anything. It has to occur in order for the markets and the banks to function, right? So just a quick summary on the zero sum game. And zero sum game basically means for someone to win, someone else has to lose. There has to be, for every buyer, there has to be someone on the other side of the trade, which is a seller, and vice versa for sellers. There has to be buyers. When you press buy on your broker, the seller is when you press buy on your broker, the seller is the one that it's selling to you. So obviously, if you and how basically money is taken, it's not made. So as soon as you commit your capital into the market and press buy, your money is fair game. All right. So what you have is a stop loss, right? And your stop loss order is actually a sell order, right? Sell, or if you want to call it supply, right? It's a sell order, right? And you'll take profit, right? TP is also a sell order when you look to buy. SELL. Right. So when you buy, the broker takes the other side of the trade. If you lose the trade and price go against you, you are forced to sell at a lower price. If you bought at 10 and your stop loss is at 7, and prices go down to 7, you lose whatever you risked on that. And what the broker does is that they sell for 10 and buy back for 7. So they make a profit. And obviously it's the other way around when it comes to taking profit. These guys, the other person on the other side of your trade, is forced to buy at a higher price, buy back at a higher price. They sell to you for 10, but they're forced to buy back if you take profit and you sell back to them. Let's say, for example, that was 13, whatever the price is. So yes, that is pretty much how it works. Yeah, so there's always someone on the other side of your trade, and it's really important to keep that in mind, and the fact that money is taken, it's not made, and it's really warfare, right? It's really a case of, it's not nice, it's not pleasant, but people, entities, financial institutions are after your money, and you should be in the mindset that you are after their money, right? So everything you do in the Forex market, every time you take a trade, you should be mindful as to who is after your money and how you can take advantage of them. So the Forex market share, foreign exchange interbank market, and I'll read a little bit of this. So most of the total Forex volume is transacted through about 10 banks, and main banks you'll hear about: Deutsche Bank, UBS, etc. The main thing I want to point out is that the elite group of institutional investment banks is primarily responsible for making prices for the bank's interbank and institutional clients. And what's really important and for offsetting that risk with other clients on the opposite side of the trade, right? So there has to be other clients to offset their main client's risk. And this is just a Euromoney survey on the major 10 banks that really move price, within the Forex market, and they have a massive market share of something like maybe 50-60%, is the major 10 financial institutions. So iceberg orders, liquidity, and slippage. This is why the market has to move and function in the way that it does. And the iceberg orders really refer, and the basics of iceberg orders is used by institutional investors, and this is from Investopedia, but the same concept applies exactly, in stocks and in Forex as well. So institutional investors, you could say financial institutions, to buy and sell large amounts of, securities or currencies for their portfolios without tipping off the market. Yeah. So only a small portion of their entire order is visible at any given time. By masking large order sizes, an iceberg order reduces price movements caused by substantial changes in, a currency's supply and demand. Yeah. For example, a large financial institution may want to avoid placing a large sell order that could cause panic. Yeah, they might want to dump, euros or dollars or pounds, etc. All right. And because we know that 10 major banks control a large portion of or have a large market share, if one of those large financial institutions starts to look to sell or even buy, it's going to move the market, right? So a series of smaller limit orders may be more palatable and disguise the extent of the selling pressure, right? Exactly. On the other hand, an institutional investor looking to buy shares at the lowest possible price may want to avoid placing a large buy order that day traders could see and bid up the stock or, for example, the currency. So the key takeaways is that iceberg orders are large orders that are split up into lots of small sized limit orders. They split up into visible and hidden parts, with the latter transitioning into visibility after the former type of order is executed, right? So basically meaning that they have loads of limit orders, and once they're triggered, then they become visible. They are typically placed by large institutional investors to avoid disrupting trading markets with a single large order. All right. And one of the the issues that large institutions have, they can't transact like how us retail traders transact, right? They need a liquid market, right? Then what I mean by liquid market is they need enough buyers and sellers within the market in order to facilitate their transactions. So let's say, for example, they have maybe 100 million pounds or dollars worth of a certain currency that they want to buy. Yeah, what they can't do is just say, all right, then I want to buy 100 million pounds worth if the average that they normally buy, for example, is maybe 20 million a day or something like that. If you know what I mean, there's going to be problems there. They're going to move the market, right, unnecessarily. So what they have to do is look for a lot of the market. First of all, has to be liquid, right? There has to be enough sell orders in order for them to place their buy orders, because there has to be someone on the other side that's selling, that's willing to sell them 100 million pounds worth of whatever currency they're willing to buy. Yeah, so a liquid market is with many available buyers and sellers, comparatively low transaction costs. The details of what makes a liquid market may depend varying on the asset being exchanged. In a liquid market, it's easy to execute a trade quickly and at a desirable price because there are numerous buyers and sellers, right? And the product being exchanged is standardized and high demand, right? So in a liquid market, despite daily changes in supply and demand, the spread between what the buyer wants to pay and what the sellers will offer remains relatively small. The opposite of a liquid market is called a thin market, or in an illiquid market, thin markets may have considerably large spreads between the highest available buyer and the lowest available seller. So a liquid market, has many buyers and sellers. So again, if the banks want to buy 100 million worth of a certain currency, they need to have a very liquid market, right, in order for them to facilitate that order. So they need to have it some 100 million pounds worth of sell orders, especially at certain price range as well, in order for them to get involved in that. Now, the problem not only with having a liquid market or not having a liquid market for the financial institutions is slippage, right? So slippage in the forex market, slippage occurs when the market order is executed or a stop loss closes the position at a different rate than set in the order. So slippage is more likely to occur in the forex market when volatility is high, perhaps due to news events or during times when the currency pair is trading outside peak hours. In both situations, reputable forex dealers will execute the trade at the next best price. So what that pretty much means is, and let me draw this on here, right? So what that means is you have a market, where this is price and this is time. And what the financial institutions need, if they want to buy 100 million, right, first of all, they need to break that 100 million down into smaller parts. So let's do like 5 million here, 7 million there, etc. Right, to their iceberg orders, right? So they've got limit orders at certain prices. So what they need is enough sell orders in order to facilitate their buying. They need someone to take the other side of their buy orders. And so if they just dump or buy 100 million, let's say for example there's not a liquid, the market is liquid, but at different price points, by the time they get filled, right, on their 100 million, let's say for example liquidity down here, there might be maybe 40 million, right, at this price point. And as we go higher, there might be 20 million worth of sell orders, right? Remember, they want to buy, so they need sell orders. And then here there might be 10 million, etc., right? By the time they get filled, they're buying at expensive prices. They don't want to buy as the market is going higher and their orders get filled at different price points. They want to be able to buy their 100 million at a certain price level. They want to be able to buy in and around a certain area. And remember, it's not just one financial institutions, there are loads of financial institutions, especially the top 10. So they're all being watched and they have to disguise their iceberg orders, right? So slippage occurs. What slippage is the inability to be able to fill a market order at a desired price. So they might have some limit orders at this price point. Let's say for example that was 1, but if there's not enough sellers, then they might get filled at 2, at 2 price point, and then they might get filled, another batch of those iceberg orders might get filled at 3, right? So this is what slippage is, and this is what the financial institutions attempt to avoid by understanding that they need a liquid market and they need to hide their